Stop what you're doing for a moment. Close the other tabs. Put your phone down for just a second. Because what we're about to discuss today could determine whether you protect your wealth in the coming years or lose a large portion of it during the next financial storm. Now I know that sounds dramatic, but history teaches us something important about financial markets. The biggest risks are almost always invisible when everyone feels comfortable. They hide beneath record stock prices, booming tech companies, and headlines telling us the economy is stronger than ever. And then suddenly, everything changes. Markets turn, liquidity disappears, and the same assets people were chasing yesterday become the ones they can sell fast enough today. That's why today's discussion is so important. Because beneath the surface of today's financial system, a series of powerful macro forces are starting to collide. Debt, geopolitics, currency competition, commodity shortages, and a global monetary system that may be entering its most fragile moment in decades. Some people won't like what I'm about to say. Some will say this is pessimistic. Others will say markets always recover. But my job isn't to make people comfortable. My job is to show you the patterns, the data, and the historical signals, so you can decide for yourself what's coming next. And when you step back and look at the bigger picture, it becomes clear that we may be approaching one of the most important economic turning points of our lifetime. Welcome back to John Forecast, where we break down gold, silver commodities, and the macro forces shaping global markets. If you're someone who wants to understand what's really happening behind the headlines, you're in the right place. Because today's conversation goes far beyond any single asset. This is about something much bigger. It's about a global financial system that may be slowly shifting into a completely new phase. And once you start seeing the signals, they appear everywhere. The illusion of stability. Let's start with the biggest illusion in financial markets today. Stability. If you only look at stock indexes, things appear strong. Corporate earnings look solid. Technology companies continue to dominate headlines. And every time markets dip slightly, investors quickly step in to buy the dip. But here's something interesting. Financial markets often look the strongest right before major turning points. Think about the year 2000. The dot-com bubble was at its peak. Tech stocks were skyrocketing. People believed the internet had created a new economic era where traditional rules no longer applied. Sound familiar? Then within months, the Nasdaq collapsed nearly 80%. Trillions of dollars in wealth disappeared, and companies once valued at billions suddenly became worthless. The same thing happened before the 2008 financial crisis. Housing prices kept rising. Banks kept lending. Investors believed real estate could only move in one direction. Then the system cracked. Major financial institutions failed, and the global economy entered the worst recession since the Great Depression. The point is simple. Financial systems don't collapse slowly. They look stable until suddenly they're not. The debt problem nobody wants to talk about. Now let's talk about the single biggest structural risk in the global economy today. Debt. Right now, global debt has exceeded $300 trillion. That includes government debt, corporate borrowing, and household loans. To understand how massive that number is, consider this. The entire global economy produces roughly $100 trillion of economic output each year. That means the world now carries roughly $3 of debt for every dollar of economic production. This level of leverage has never existed in human history, and the system has been able to sustain it for one simple reason: low interest rates. For over a decade after the 2008 crisis, central banks kept borrowing costs extremely low. That allowed governments, corporations, and consumers to accumulate enormous amounts of debt without feeling immediate pressure. But when interest rates rise, the math changes very quickly. Suddenly, the cost of servicing that debt becomes much higher. And when debt becomes harder to service, financial stress begins spreading throughout the system. The gold signal. Now here's where things get fascinating. While many investors focus on stocks or technology companies, one asset has been quietly sending a powerful signal about the state of the global economy: gold. Over the past few years, gold prices have surged to record highs, breaking through levels that stood for decades. But what's even more interesting isn't the price movement itself. It's who is buying gold. Central banks. Governments around the world have been purchasing gold at the fastest pace in modern history. According to the World Gold Council, central banks bought more than 1,000 tons of gold annually in recent years, one of the largest accumulation periods ever recorded. And that raises an important question. Why are central banks buying so much gold? The answer is simple. Gold has always been the ultimate financial insurance policy. It's a neutral asset. It doesn't depend on any government. It can't be printed. And for thousands of years, it has served as a store of value during periods of economic instability. When central banks start accumulating gold aggressively, they're usually preparing for something. Let me ask you a quick question. If governments around the world are quietly preparing for potential financial instability, should individual investors be paying attention? Because most people don't notice these signals until after the crisis begins. Now, let's talk about another powerful force reshaping global markets: Geopolitics. For decades, the global financial system has revolved around the US dollar. Most commodities are priced in dollars. Most international transactions flow through dollar-based payment systems. And for years, this gave the United States enormous financial influence. But today, that system is slowly evolving. Countries like China, Russia, India, Brazil, and Saudi Arabia have begun exploring alternatives to dollar-based trade. Some trade agreements now settle transactions using local currencies. Others involve direct commodity exchanges. And at the same time, several major economies are increasing their gold reserves dramatically. Why? Because gold acts as a neutral financial asset in a world where geopolitical alliances are becoming more complicated. Now let's shift our attention to something else happening beneath the surface of global markets: commodities. Unlike financial assets, commodities represent physical resources, energy, metals, agricultural goods. And today, several commodity markets are facing serious supply challenges. Oil production remains sensitive to geopolitical tensions in key regions. Copper demand is surging due to global electrification and renewable energy infrastructure. Silver demand continues rising because it plays a critical role in solar technology and electronics. These structural trends are leading many analysts to believe the world could be entering the early stages of another commodity supercycle. The last time this happened was during the early 2000s, when rapid industrialization in China triggered massive demand for raw materials. During that period, commodity prices surged for nearly a decade, and some economists believe similar forces could now be forming again. But perhaps the most fascinating part of financial markets has nothing to do with numbers. It has to do with psychology. Every major speculative bubble in history follows a similar pattern. Phase 1 is the stealth phase. Smart money quietly accumulates assets before the public notices. Phase 2 is the awareness phase. More investors begin paying attention. Prices start rising faster. Media coverage increases. Phase 3 is the mania phase. Everyone wants in. Taxi drivers talk about stocks. Family members discuss investments at dinner. Prices accelerate dramatically. Phase 4 is the blow-off phase. Valuations become disconnected from reality. And finally, phase 5 is the collapse. Confidence disappears. Prices fall rapidly, and investors realize the risks they ignored earlier. History has repeated this cycle over and over again. Tulip mania in the 1600s, railroad speculation in the 1800s, the dot-com bubble in 2000, the housing bubble in 2008. Each time, the pattern looked almost identical. Now, here's something very important to understand. Major economic transitions often involve massive wealth transfers. Money moves from one group of assets to another. During the 1990s, capital flowed heavily into technology stocks. After the dot-com crash, commodities entered a powerful bull market. During the 2010s, low interest rates pushed capital into financial assets again. But if inflation remains elevated and geopolitical tensions continue rising, capital may begin shifting toward real assets once more. Gold, silver, energy, industrial metals, land, physical resources, assets tied to tangible supply and demand. Think about this for a moment. If the global economy enters a period of higher inflation and geopolitical fragmentation, which assets would benefit the most, and which assets might struggle? That's the question many institutional investors are asking right now. Large institutional investors often focus on signals that retail investors overlook: central bank activity, commodity inventories, currency flows, geopolitical alliances. And many of these signals today suggest the world could be entering a more uncertain financial environment. When uncertainty rises, investors tend to prioritize capital preservation over speculation. And that shift alone can dramatically change market dynamics. So what does all of this mean? It means the global financial system is entering a period of transformation. Debt levels are historically high. Geopolitical alliances are evolving. Commodity markets face structural pressures. And central banks are quietly preparing for potential instability. That doesn't mean a financial crisis is guaranteed tomorrow, but it does mean investors should begin thinking carefully about risk management, diversification, and long-term strategy. Because when financial conditions change, they often change much faster than people expect. History shows that the biggest financial mistakes happen during periods of extreme confidence, when everyone believes the system is stable, when markets seem unstoppable. That's exactly when preparation matters most. Understanding macro trends, watching what central banks are doing, paying attention to commodities and real assets. These signals can help investors navigate uncertain times. If you found this analysis helpful, make sure to subscribe to the channel for more deep dives into gold, silver commodities, and global macro trends. And now I want to hear from you. Do you think the global financial system is heading toward another major turning point? Or do you believe the current market cycle will continue for years to come? Drop your thoughts in the comments below. I read every single one. Thanks for watching. And I'll see you in the next video.